Chapter 2, how do you qualify? Now that you know the three paths of lending, let's move to the second most popular question I hear all the time. How do I qualify, Brian? This chapter is important because you need to be able to know how to pre-qualify your business for funding. This will save you time and money. You do not want to waste time filling out multiple applications, which can affect your credit score when you have too many inquiries. So with that said, let's discuss how to pre-qualify yourself so you can better understand how to qualify for each one of the three lending paths mentioned. Let's start with the credit-based funding path first. How do I qualify for credit-based funding? Now, let's discuss how you qualify for credit-based funding. Clearly, at this point, you should know the lender will be looking at your personal or business credit, but what are they going to be looking for in your report? It is a common assumption that people think the lender will only be focused on the score for this specific program. This is not true. A score just indicates if you are a borrower that pays your bills on time. The next, they need to determine how much funding they can extend to you, and this part is not determined by the score. There are four factors the lenders will look at to determine approval and how much to approve the request. The first factor is derogatory items. We are talking about late collections, charge-offs, tax liens, judgments, and bankruptcies. The last thing underwriters look for is inquiries. As mentioned earlier, banks only lend money to people who don't look like they need money. This means if you have a lot of inquiries on your credit profile, you look desperate. No bank wants to lend money to a desperate borrower. So you need to limit the number of inquiries on your file. To sum it up, there are four things they look for to qualify for credit-based programs: derogatory, utilization, age of file, and inquiries. Keep in mind, we have seasoned pros. And if you need help to address any issues you have with either one of these factors prior to reaching out to a lender, visit our website at www.penningtonconsultinggroup.com. We can help you prepare your file for funding so you can maximize your approvals when you submit your application. Depending on your funding goal and how much effect the derogatory item has on your credit profile, this will determine the amount that the lender is able to extend to you or your business. For example, someone looking for $5,000 and someone who is looking for $100,000 are two different types of borrowers. The second factor is utilization. This is a calculation based on the total balances divided into the total limits of all your revolving accounts credit cards. For example, if you have a credit card with a $1,000 limit and a $500 balance, you are 50 utilized. What you want to do is make sure you are below 30 utilization to get favorable amounts and terms. Always remember, banks lend money to people who look like they don't need the money. The third factors lenders look for is age of the file. Now, we are not talking about how old you are here. We are talking about how old your credit profile is based on the oldest item reporting on your credit profile. The more seasoned your credit file is, the better you benefit from this factor. How do I qualify for revenue-based funding? Clearly, understand that to be considered for any product that falls under the revenue-based lending path, a business must show proof of income or potential future revenue. What the lender will evaluate in this funding segment is very specific to the funding program. As covered earlier, there are a few different funding programs that fall under this lending path: revenue term loans, merchant cash advance, purchase order financing, factoring loans, and revenue line of credit, just to mention a few. So let's quickly go over each one of these funding options and discuss briefly what the lenders underwriters are looking for based on the program. For example, if we are talking about a merchant cash advance, the only thing the lender will evaluate is your merchant processing statement or your business bank statements. For merchant cash advance, no tax returns, financial statements will be requested based on your processing volume. The lender will determine how much you can borrow and how much your payback will be, which is completely different from purchase order financing, where you can obtain funding based on future revenue. If, for example, let's say you are one of the top candle makers in the world, and Walmart wants to order 1 million candles from you for an upcoming holiday season. Let's just assume in our example here, you do not have the money to satisfy the $1 million order. And of course, Walmart will not pay until you deliver the candles ordered. In this scenario, you can approach a purchase order financing company and present to them the executed purchase order from Walmart. The lender will be able to extend to you between 50-80 of the value of the purchase order immediately to assist your business with the funding needed to manufacture the candles. In this example, the lenders will emphasize on evaluating Walmart as your client. And why, may you ask? The reason why is that the lender will keep the loan funds extended to you when Walmart pays the invoice once the candles are delivered. This is why the underwriter will evaluate Walmart as well as your business. The lender may even assess the business credit of Walmart, the company making the order in our scenario. They would do this to determine how much they can advance your business. The reason for this is because once the invoice is paid in our scenario by Walmart, the lender makes a profit by taking a percentage of that invoice for advancing your funds initially, which is different from invoice factoring. Invoice factoring is another unique form of funding under the revenue lending segment to obtain funds for your business based on potential future revenue. Factoring loans are commonly used in the construction business. To better explain this, it is important to understand the construction industry and their pay per performance pay structure. To make that make sense, construction businesses do not get paid until the job is completed. Clearly, though, for the project to reach completion, there are upfront costs associated with the job. These expenses include payroll, supplies, permits, and etc. For example, let's say you have a contract with the government for the construction of a building. The government will require a few phases to be completed and inspected before they will pay you for work completed. But you will have to pay your vendors, workers, and suppliers before your client. The government will pay you as agreed for work completed. So what you can do and what is commonly done in the industry is to obtain a factoring loan as you are working on the project. In this scenario, once your job is completed and you are waiting for payment from your client, the government, you can approach an invoice factoring company that will be able to take that invoice you submitted to your client. And based on that invoice and your business previous work history, the lender will be able to extend an advance to your business while you are still waiting to get paid from your client, the government. The advance is typically a percentage of the invoice, could be between 50-80 of the invoice total. This is an example of how factoring loans work. Simply put, it's a program to assist business in any industry where it's a pay-per-performance structure. Now let's discuss another program that falls under the revenue path revenue lines of credit. This is where a lender is able to extend the line of credit to your business based on proof of previous income. The lender may look at a variety of documents to show proof of income. These documents include, but are not limited to, tax returns, P&L statements, bank statements, etc., to determine how much they are able to establish in a line of credit for your business. Lastly, you have revenue term loans. These are loans given to the business based on a previous revenue of the business. Revenue term loans come with a fixed rate, a fixed monthly payback amount, and fixed term from 12 months, 30 years. With all these programs mentioned here in the revenue-based funding segment, you must show proof of previous or future income for the business. To summarize, to qualify for revenue income-based funding options, income verification is required. As a reminder, if you need help with any of the products mentioned here, feel free to reach out to us at www.penningtonconsultinggroup.com. We have seasoned professionals that can help you regardless of your current situation. As a reminder, credit is not a disqualifying factor for revenue loans, but it is a compensating factor for revenue loans, which means it does not matter what your credit score is. You can still be offered funding, but someone with a 700 credit and someone with a 480 credit score, if they both apply for a loan, the borrower with the higher credit will be able to get more favorable terms than the borrower with a lower credit score. So keep in mind, for better terms, good credit is key. How do I qualify for asset-based funding? As you should know, at this point, this lending path requires that collateral is pledged for all the programs in this funding segment. The collateral pledge determines terms of financing, if you qualify, how much you qualify for, and etc. Some of the programs that fall under the asset-based funding segment are real estate loans, equipment financing, stock loans, or even settlement loans. What it takes to qualify depends on the type of asset program we are talking about. Let's take some time to break down each one of the programs individually to better elaborate on how to qualify and what the lender is looking for. For example, in real estate, what the lender will be evaluating to see if you qualify is the real estate, the value of the real estate, the location of the real estate, the type of real estate it is, commercial, residential, etc. It's different if you are talking about residential VZs, commercial. If you are talking about a grocery store, it's underwritten differently. Well, it's important to understand generally the only type of stocks that can be pledged as collateral are publicly traded stocks. Lenders will not collateralize privately held stocks. What the lender will do is take into account the type of company it is. They will evaluate the market cap, the CEO, maybe even the earning potential, ratio, etc., to see if you qualify for this specific funding. Lastly, you have settlement loans. Settlement loans give you a cash advance against an expected legal settlement, while you can get the cash you need to pay for necessary expenses right away. To qualify, the lender will evaluate the case, the judgment itself, and also the paying party to determine how much they can extend to you or your business. I do want to emphasize that even though credit is not a disqualifying factor, it is a compensating factor when you are talking about asset-based loans, which means it does not matter what your credit score is. You can still qualify for asset-based lending, but someone with a 700 credit score and someone with a 480 credit score, if they both apply for a real estate equipment or stock loan, the borrower with the higher credit will be able to get more favorable terms than the borrower with a lower credit score. So you cannot forget that credit is a compensating factor as it pertains to asset-based funding. Let's say an apartment complex or a community center or a church. These all fall under commercial real estate, but they will all be evaluated differently based on the type of asset being pledged. Also, the type of asset being pledged can dictate the LTV into value. The loan to value ratio is a financial term used by lenders to express the ratio of a loan to the value of an asset purchased. The max LTV given to an apartment complex generating revenue monthly is going to be different than an LTV given to a church or a community center. Now let's discuss equipment funding and how to qualify. There are two ways you can obtain funding for equipment. You can either obtain funding to purchase new or used equipment, or if you currently own equipment, you can obtain funding through what is called an equipment sales leaseback, which is very similar to a cash out refinance in real estate. This is where you approach a lender and pledge as collateral the equipment you currently own. In return, the lender will offer you financing. So this is another very unique way you can obtain funding for your business. You can use this for office equipment, furniture, computer, cars, trucks, etc. Now, let's talk about stock loans. Most people don't know that you can actually borrow money against stocks you own. How do I prepare myself and my business for funding? Now, let's discuss how to prepare for funding and what is needed to qualify based on whatever funding path you choose. Remember, you need to have your basic information, your address, your IN number for your business, your articles of incorporation are required for all three business paths. Also, keep in mind, your credit is always considered a compensating factor for each of these lending paths. So make sure your credit is positioned for funding. Later on in this chapter, I will go over some basic rules on managing your credit, and I will cover in that chapter how to position your credit for funding. Now, there are a few things here you to consider based on the type of funding path you are applying for. By now, you should have an understanding of what funding path you can be considered for, because what you need to do to prepare for funding is different based on the funding path and program in question. So let's break this down based on each funding path. First, let's discuss credit-based funding. The lender will be evaluating 4 factors on your credit profile. These factors are derogatory credit utilization, age of file inquiries. Derogatory marks are negative reporting on your report. For example, late payments, charge off, collections, or bankruptcy appears on your reports as a derogatory mark. Credit utilization is the ratio of your outstanding credit card balances to your credit card limits. It measures the amount of available credit you are using. For example, if your balance is $500 and your credit limit is $1,000, then your credit utilization for that credit card is 50. Age of file tracks the age of the oldest trade lines on your report. Generally, the longer an account has been open and active, the better it is for the credit score. A credit inquiry is a request by an institution for credit report information from a credit reporting agency. So now that you understand the four factors and what they are, let's go over some quick tips on how to prepare for credit-based funding. You need to make sure you clear any derogatory items off your credit profile and maximize your approval. Also, make sure your balances are not high, preferably below 30 of the available credit. Lastly, limit the number of inquiries on your credit report. As a reminder, banks only lend money to people who don't look like they need money. So if you have a lot of inquiries on your credit, you need to consider doing credit cleanup. To have the inquiries removed, please visit www.penningtonconsultinggroup.com. Our seasoned experts will coach you and assist you with making any necessary adjustments. You prepare your file for funding. So now let's discuss the revenue-based funding path and the steps you need to take to prepare for funding. Given the fact that documentation is mandatory with this path, you need to get your documents together. The documents you need are specific to the type of lending product you are talking about in this lending segment. As a reminder, there are a few products in the revenue-based funding path, but generally, lenders will want to review your last 6 months bank statements. Quick tip here, as it pertains to bank statements, stop using your business bank account for personal items. Lenders do look at this. If an underwriter is evaluating your bank statements and they see Netflix, Amazon Prime, Chick-fil-A charges on your bank account, it does not look professional. The underwriter may not be favorable to your file. I always tell my clients underwriting is all about perception. You have to understand the underwriters are trained to look for reasons to reject a file. So don't give them a reason to. Perception is key. This can make a difference if you get approved for $20,000 or $50,000 based on your spending habits on your bank statements. These are things underwriters consider. You do not want to have these types of transactions on your business bank account. Also, for the revenue-based funding, you want to make sure you have all your financial statements in order. I am talking about profit and loss statements, monthly balance sheets, business tax returns, and etc. If you are considering factoring or P's, make sure you have a copy of the signed invoice to present to the lender. These are things you need to prepare for if you want to be considered for the revenue-based funding program on asset-based lending. Make sure you have information about the specific asset you wish to pledge as collateral. For example, in real estate, make sure you have the address of the asset. If you are pledging equipment, if it's a car, truck, you need to have the VIN number. You need to have the mileage. If it's some type of equipment, you need to have the running hours of the equipment. The lender will usually want to see a picture of the equipment. And in real estate, take pictures of the property, provide them multiple pictures with different angles. If we are talking about stock loans, make sure you have your brokerage statement from your firm showing what stocks you want to pledge. Now, let me be clear here. For revenue financing, these documents must be recent documents. Do not submit a 6-month-old bank statement or a broker statement from last year. You will be wasting your time and the underwriter's time. These statements generally must be within the last 30 days, definitely not more than 90 days old. Hopefully you have a general overview of what will be required of you to provide, and also you have a sense of what underwriting will be evaluating to make their decision. I always say to my client, preparing for business funding is like preparing for a big event like a wedding or prom. You must prepare for these events weeks, even months in advance. The same with funding. Don't be one of those borrowers that completes an application abruptly without not knowing where you stand. There's been plenty of times I've spoken to borrowers about funding, and I simply just ask, what would you say your credit score is? Half the time, borrowers usually say, I don't know. This is simply not acceptable as a business owner. You must know these types of things. And my goal with this book, as mentioned, is to empower with the information you need and to give you an underwriter's perspective to make sure next time you need funding for your business, it's a smooth process.